If you still think the Federal Reserve is mainly managing inflation, then you are reading the wrong part of the story. The real story is not inflation by itself. The real story is that the system now needs more money printing to survive than the currency can comfortably absorb. That is the trap. And when a country reaches that point, the most important thing being repriced is not one interest rate decision, not one treasury auction, not one jobs report, not even 1 month of CPI. The thing being repriced is the border between money and trust. That is the line I want you to hold in your mind all the way through this. Not because it sounds dramatic, because once you understand that line, you stop treating policy like a set of neutral decisions and start seeing it for what it has become. A series of increasingly desperate choices designed to keep the debt machine alive without admitting what that survival now costs. Most people are still not looking at the system this way. They hear the phrase, "the Fed is printing money again," and think it is just another commentator's slogan. They hear inflation is accelerating and think it is just another monthly complaint about groceries, gas, and rent. They hear rates may stay higher for longer and think it is just a technical disagreement between economists. That is not how I see it. I see a system that has reached the stage where all of its core problems begin reinforcing one another. Debt requires lower rates, inflation resists lower rates, higher rates break refinancing. Broken refinancing demands liquidity. Liquidity feeds inflation. Inflation prevents clean rate cuts. The whole thing goes in circles. That is the machine. And if you are a saver, a retiree, a middle-class family, or anyone holding most of your wealth in ordinary dollar-denominated claims, then you are already living inside the consequences of that machine, whether you have named it or not. Now let me say something plainly, because this is the sentence that organizes the whole story. The Federal Reserve is not printing money again because conditions are healthy enough to support expansion. It is printing money again because the system cannot clear honestly at current debt levels without help. That is the confession. And once you hear it that way, you stop thinking of new reserves, new purchases, and new management operations as mere technical plumbing. They become what they really are, a bridge between the debt structure the country already built and the demand structure the market no longer supplies voluntarily at acceptable prices. That is what matters, not the label. The function, a lot of people still get distracted by the language. If the Fed buys longer-term treasuries, they call it quantitative easing. If it buys short-term bills and insists this is merely reserve management, people nod as if the semantics change the economics. They do not. I have watched too many institutions rename the same medicine when the original name becomes politically embarrassing. The medicine is still the medicine. If new money is created and used to absorb government paper because the system needs that support, then the effect is still monetary accommodation. It is still a form of inflationary support. It is still a way of keeping the debt machine moving when a free market would otherwise demand terms too painful for the issuer to accept. That is why I do not get hypnotized by wording. I care about flow, who is creating the money, where it is going, what problem it is solving, what problem it is postponing, and what price the currency will eventually pay for the postponement. That is how I want you to think too. Now let us start with the first mechanism, the debt absorption problem. If you strip away all the theater, the issue is embarrassingly simple. The United States government needs a vast amount of financing. The debt stock is enormous. The refinancing need is enormous. Deficits are ongoing. Interest expense is already grotesque, and the market's natural appetite for swallowing all of this debt at low cost is no longer strong enough to make the process look easy. That is the problem. Everything else is a reaction to that. Now, in a healthier era, this would be unpleasant, but manageable. You would raise yields. More private money would appear. The price of borrowing would go up. The fiscal authority would face pressure. Policy would adjust. The system would be disciplined by cost. That is what should happen. But the debt stock is now so large and the political class so dependent on borrowing that true discipline has become systemically dangerous. Higher yields do not merely punish the government in the abstract. They transmit into mortgages, corporate financing, commercial real estate, private credit, consumer debt, and every long-duration asset in the system. That is what makes this era so unstable. The issuer at the center of the system is now too indebted to tolerate honest pricing. Yet the honest pricing is precisely what the market wants. That conflict produces money printing, not as a luxury, as a bridge. If the free market does not want enough treasuries at 3%, 4%, or whatever level policymakers would prefer, then some buyer must appear. That buyer increasingly becomes the central bank, directly or in shadowed form. That is the debt absorption problem in plain English. Not theory, a shortage of real voluntary buyers at comfortable prices. Now let me sharpen it further. A lot of people still think the treasury market is sacred. They think if the United States issues debt, the world will always buy it because it always has. That is lazy thinking. Buyers buy at prices. They buy under conditions. They buy because they trust the inflation path, the currency path, the fiscal path, and the institutional path enough to accept the return offered. Once that trust weakens, demand becomes conditional. Conditional demand means higher yields. Higher yields mean more fiscal pain. More fiscal pain means stronger pressure on the central bank to intervene. And central bank intervention means more money creation. That is the loop. Now add the second mechanism, inflation persistence. The system could perhaps tolerate hidden support more easily if inflation were deeply dead, wages were stable, energy were calm, and the public still believed purchasing power would be defended at any cost. That is not the world we are in. Cost pressure is still alive. Energy is unstable. Oil is elevated enough to feed through into transport, food manufacturing, and consumer psychology. Insurance is ugly. Services inflation is sticky. The cost of ordinary life remains far above where polite economists would like it to be. That matters because every new round of support now arrives in a world already suspicious of dilution. This is not 2011, this is not 2014. The public has already lived through a period in which inflation ripped through savings and wages hard enough to destroy the illusion that money only loses value gradually and politely. Once the public has seen that, the next round of support lands differently. Maybe the official inflation number looks manageable for a month or two. Fine, the public does not live in the official number. It lives in bills, food insurance, fuel rent, maintenance, health care, child care, mortgage rates. That is the lived inflation rate. And when the public sees money being created while those costs remain elevated, it begins connecting dots that central bankers would greatly prefer remain disconnected. That is why this moment is more dangerous than the technicians want to admit. The support is returning before the inflation memory has faded. That means the credibility cost is higher. Now comes the third mechanism, the long-end rebellion. People hear money printing and think the effect is immediate relief. Sometimes in the short term, yes, but if the support is arriving because real demand for sovereign paper is weakening, then the deeper problem may not go away at all. It may simply move. If the market begins thinking that the central bank is supporting debt issuance because the state cannot otherwise finance itself on tolerable terms, then the long end may demand more compensation, not less. That is what makes this period so treacherous. The same action meant to stabilize one part of the system can destabilize another. The 10-year yield matters here. The 30-year matters even more. These are not just abstract rates for bond traders. They are the reference points for mortgages, investment math, pension assumptions, discount rates, and asset valuation across the economy. If those yields remain elevated or rise, then the central bank's quiet support does not really solve the problem. It merely reveals the problem more clearly. That is why I watch the long end so closely. A trapped central bank can support bills, it can massage liquidity, it can manage language, but if the market keeps demanding a larger term premium to lend long, then the message is merciless. The market is no longer granting the old level of confidence. That matters more than any official statement. Because confidence granted by markets is the true foundation under a fiat regime, not the press conference. Now let us bring in the fourth mechanism, mortgage transmission. This is where the abstract becomes intimate. The average American family does not spend its day thinking about treasury bills, reserve management, or the Fed's balance sheet. It thinks about the monthly payment. That is where policy becomes personal. When the 10-year yield rises, mortgage rates move with it. When mortgage rates rise, the same house becomes dramatically more expensive, not because the lumber changed, not because the roof changed, because the money changed. That one transmission line has destroyed more middle-class momentum in this cycle than most people understand. The payment on a home financed in the cheap money era and the payment on that same home financed in a higher rate era are not cousins. They are different universes. That is what a money regime change does. It breaks the bridge between income and ownership, a whole class of wood. B. Byers discovers that the issue is no longer discipline, saving, or credit score. In the old sense, the issue is that the price of money has severed the relationship between ordinary wages and ordinary wealth. Building, that is why I never treat high yields as just a bond market story. They are a housing story, a family formation story, a birth rate story, a mobility story, a retirement story, a dignity story. And if the central bank must keep printing to support the debt structure while the long end remains uneasy enough to keep mortgage rates elevated, then the middle class is being attacked from both sides at once. Purchasing power erodes. Ownership gets harder, savings lose real value, debt service stays heavy. That is how a currency crisis begins in the developed world. Not with wheelbarrows, with life becoming unaffordable in increasingly subtle ways. Now let me say something about the official inflation number, because many people get trapped in arguments about whether the number is real or fake in a childish all, or nothing way. That is not how I look at it. The real issue is not whether one inflation statistic captures every private experience perfectly. It never will. The real issue is whether the broad direction of money creation, debt support, and cost pressure is consistent with a stronger currency or a weaker one. That is the correct frame, and in that frame I see very little reason for confidence. A state with too much debt, a central bank under pressure, quiet support already returning, long end rates uncomfortable, inflation not safely dead, geopolitical cost shocks alive, a political class that still wants all the spending and none of the pain. Put all of that together and tell me what kind of currency regime that describes. Not a disciplined one, a compromise regime. That is the word compromise. Once you accept that, the whole investment map changes, because compromise regimes do not reward the same habits that disciplined regimes reward. They punish fixed nominal promises more often. They reward pricing power more often. They make real assets more interesting. They make scarce assets more interesting. They make short duration liquidity more useful. They make hard stores of value impossible to dismiss. That is why I want to shift now to the gold story, because this is where most people are still badly behind the real sequence. Gold does not begin moving. Only after the public finally agrees the central bank has lost control. That would be too easy. Gold moves in stages. The first stage is quiet official accumulation and strategic positioning. The second stage is institutional recognition that the central bank is trapped and that the integrity of the currency will likely be compromised through support, repression, or toleration of higher inflation rather than through clean discipline. The third stage is broad public realization. Most people only notice stage 3. That is why they are always late. I think we are in stage 2. And stage 2 is where the most interesting revaluation happens, because the crowd is still using the vocabulary of temporary policy complexity, while the market is beginning to understand that the complexity is not temporary at all. It is structural. Now I want to explain why stage 2 is so powerful. In stage 1, the public still sees gold as old, boring, maybe even paranoid. Central banks and a few large actors accumulate quietly because they are not seeking social validation. They are reserve managers. They care about structure, not headlines. In stage 2, the investor class wakes up, not all at once, but enough of it does. It realizes that the central bank cannot honor all constituencies at once. It cannot defend the currency perfectly, support the debt perfectly, rescue the real economy perfectly, and preserve all legacy valuations perfectly. Something will have to give. That something is what gold prices before the public fully does. Then stage 3 comes, the loud stage. The crowd arrives. The media starts translating. The move becomes respectable. The public finally wants what the institutions wanted much earlier. By then the easy part is gone. That is why I care about the stage we are in. Now, not because it makes for a dramatic thumbnail, because it changes expected return. Now bring silver into the picture. Silver is not calm gold. Silver is gold with a faster pulse and a rougher temperament. It is monetary when the monetary thesis broadens. It is industrial when reflation, supply tension, and manufacturing demand complicate the picture. That dual character is why silver often lags the first part of the gold move and then becomes much more explosive later. If gold is the reserve metal, silver is often the participation metal. When the trade broadens, silver can run harder than gold. That is why I respect it, but I never confuse it with calm. Silver is what happens when the same monetary logic hits a smaller and more unstable market. Then come the miners. This is where people either become too excited or too dismissive. The truth is simpler. A good miner is not merely a gold proxy. It is an operating business whose margins can expand very powerfully if the gold price rises faster than its cost structure. That operating leverage is why miners can outperform the metal dramatically in the right phase. It is also why poor miners can still disappoint you. Even in a rising metal environment, structure matters. Management matters, balance sheet matters, jurisdiction matters. This is why I would never tell someone to replace gold with miners wholesale. The metal is the reserve asset. The miners are a leveraged operating expression. Those are different jobs. Now let me step back and show you the 3 traps that convince me the move is not just possible, but increasingly likely. The first is the sovereign refinancing trap. The government must refinance too much debt into an environment where honest rates are too painful. That alone creates the pressure for continued support. The second is the private credit and commercial real estate trap. There is too much fragile financing sitting under assumptions built for a lower rate world. If rates stay high, the damage worsens. If rates fall too fast through renewed money creation, the inflation problem worsens. That means some version of support is likely one way or another. The third is the political trap. No administration of either party wants the visible pain of debt deflation, collapsing asset prices, and rising unemployment if it can be postponed. That means every practical incentive points toward continued rescue, continued delay, continued support, and continued compromise in language, if not in name. When all three traps exist together, the central bank is not acting freely anymore. It is selecting how to distribute unavoidable pain. That is what a trapped central bank really does. And a trapped central bank is gold's natural ally, not because it intends to help gold, because it can no longer preserve the full credibility of paper. Now let me say something very directly to the saver. If most of your financial life is built around checking balances, long-duration bond exposure, conventional index allocations, and the comforting assumption that the Fed will eventually restore a version of the old low-rate order without a meaningful currency cost, then you are taking more regime risk than you think. That does not mean sell everything and move to a cave. I despise cartoon thinking. It means start understanding that the environment changed. It means cash is useful, but cash is not invincible. It means long-duration bonds are far less comforting in a world where the debt load itself is part of the problem. It means broad equity exposure should be re-examined through the lens of pricing power and real cash flow rather than passive habit. It means gold is not a fringe asset in a compromise regime. It becomes a reference asset. That is a major shift. And most people will only make it emotionally after they have already paid for waiting. Now let me bring this back to the middle class, because that is where the damage is most human. The middle class is always the class most exposed to invisible monetary compromise. The rich own enough hard assets, equity, business interests, and political optionality to ride over a great deal of inflation. The poor suffer brutally, yes, but often have less financial wealth to destroy in nominal terms. The middle class is the class that saves in the official channels, the retirement account, the checking balance, the bond fund, the pension, the salary that tries to keep up but does not. That is why a compromise regime is so corrosive. It punishes the obedient saver more than the flamboyant speculator in some cases. Not always immediately, but structurally. That is why I have no patience for the soothing language around reserve management, temporary support, or technical operations. These phrases are designed to keep the middle class docile while the real value of its prudence is being negotiated downward. That is what is happening. Now, I am not telling you the timing is precise to the week. I am not telling you the chart will go straight up. I am not telling you there will be no pullbacks, no volatility, no counter-trend moves, no false starts. Markets are crueler and less tidy than that. What I am telling you is that the direction of the pressure is no longer hard to identify. More debt support, more political pressure for easier money, more quiet liquidity, more inflation sensitivity, more sovereign dependence on favorable financing, more strain on the old claims of clean discipline. That combination has a direction, and that direction is what gold and then silver and then miners are beginning to hear. So here is the final choice. You can keep hearing money printing, reserve management, treasury support, and inflation concerns as separate news items, each interesting for a day and then replaced by the next one. You can keep assuming the Fed still has a clean exit hidden somewhere just because the official language remains composed. You can keep telling yourself that a little more support here and there will not materially change the long-term meaning of the dollar. Many will. Or you can do the harder thing. You can connect the flows. You can see that the system now requires support. It cannot fully name in a world where inflation is not safely dead and debt can no longer tolerate honest pricing. You can understand that gold does not need official surrender. It only needs enough recognition that the central bank is already cornered, and you can position before the crowd stops hearing technical liquidity and starts hearing what the mathematics have been saying all along. That is the edge. Not panic, not paranoia, recognition. Recognition that the system is not being managed back toward discipline. It is being managed away from visible fracture by increasingly compromising the thing that middle-class savers trusted most, the currency itself. And when that truth becomes obvious to everyone, the move in hard assets will already be much further along than the public imagines. That is why I am paying attention now. Because the money printing is back, the inflation pressure is real, the debt machine is hungry, and the lies required to keep the whole structure looking normal are already getting more expensive.